Hey guys, Jack here. Stick around after today's episode to hear how new clients can save 50% on AgYield's full suite of consulting and technology for 2025. This exclusive offer is available now until April 1st. Don't miss out. Terms and conditions apply. Check out the video description to learn more.
Good morning, everybody. It's Tuesday, January 28th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here had March corn up 2 3/4 at 484 3/4. March soybeans were up 3 1/4 at 1048 1/4, and March Chicago wheat was up 4 1/4 at 539 3/4. This morning, we had an export sales announcement of 132,000 metric tons of corn to South Korea for 24-25. Good morning, guys. Hope everybody's doing well. We were talking just a little bit here before the show. I know we're starting to see some traction in terms of Brazil soybean harvest falling behind pace. They're about 3.9% harvested, lowest since 21. And as of last week, about 2.2% of that second season corn was planted, which is down from about 11.4% from the previous year. So Justin, maybe take us through just a little bit in terms of, what that means, in the cycle and, should we be overly concerned or what the thoughts are there?
Yeah, Dan, it's obviously a slow start. It's one of the slowest, if not the slowest in the last, decade. I think there's, like 2011, 2021, we're kind of on this pace. So it's 1% planted versus, let's call it 11% or 12% on average. So there's still time to catch up, but it's if you look at like all the things that you need to have a good yield, right? That's in the negative column, right? Is having a late start. And we've talked a lot about Safrinha on this show, just how much importance, with having a tighter balance sheet here in the US now, how much more, importance is put on the Safrinha crop for the already tight global situation. So we have a tight global corn balance sheet, assuming a big Safrinha crop. So when you start getting these delays and, all these little things in these buckets that aren't ideal or that are in the negative column, you kind of have to start putting more risk premium in the market, in my opinion. So again, the weather could flip. Right now, it doesn't look like it's going to for at least a couple of weeks, but they can catch up. They're just behind. You saw that's kind of the same issues with all the wet and having some quality concerns and phytosanitary issues with China, or at least that's the excuse for some of the rejections from Chinese beans. So yeah, that'd be it's kind of like here when you start getting delayed. It's like you don't know if it's going to be just kind of a late start, if it's going to be a 2019, right? So you kind of poo-poo it early in the season until you get to that breaking point where you can't. In my opinion, that'd be like 2 weeks from now, where you're supposed to be in the 30% planted, and if you haven't moved the needle much, you really have to question what the yield potential or acres potential is for that second season crop.
Sure. Yeah. What? Nice to see another corn sale here this morning, back to back. So we're still doing some corn business, which I think is exciting for everybody here. Dustin, you had some thoughts?
Yeah, well, I just wanted to add on the Brazilian thing. I mean, you look back at like the 2010-11 year, we were 4.16 metric tons per hectare for Brazilian production, and you surround that with what we did in 2009 and 10, which is 4.34. So it definitely had a big impact in 2011. Now we're still a ways away from that in Brazil. We have, a kind of a wet 7-day forecast and a drier 14-day forecast. If that forecast changes, at all during the next week, I think you start to paint a little bit of a concern, because it's not like Argentina just had a very great season. I mean, there's a lot of people projecting sub-trend line yield for Argentina. So, we're going all the way back to global corn supply right now. You just take the global numbers at face value, just the USDA world number. It looks like we're fairly abundant because China's holding on to most of that supply. We're still sub 10% stocks to use, tightest since 2012. And like the market's been telling us something with the spreads. It's been telling us something with this 20% flat price rise. Everyone says, oh, it's just funds. There's a lot of people trying to fight this rally. And I get it. Like we had a very bearish story coming into that time frame. But a couple of things have changed since then. The USDA report came out and showed a lot less supply on hand, or a lot lower yield than we were expecting. I think that obviously kickstarted the market for one. And this poor Argentinian weather, and then a not so great start to the Brazilian planting season. It's just, I think a lot of people need to be a little bit careful on what's possible here. We very well may get that dry forecast in the 8 to 14 day. Brazilian planting catches up, and it's not a big deal. But if the wrong forecast shows up here end of this week and into the next couple of weeks, the market's not really prepared for that, for a global corn supply. And that's also tailored with very low global wheat supply ex-China. So just want to kind of throw that out there. It's like it could turn into something here. I would say in all probability things turn around and they go normal, but the setup is there. So I just want to make sure that's kind of put out there.
Yeah, I'd be in the same, I mean, obviously in the same boat there. It's, when you have these kind of things, like I don't think you can look at, 459 new crop corn and say that's just way too expensive for what we know today. Considering that it's not profitable here in the U.S. for a large majority of growers. You're looking at like Illinois. I was just having a conversation before this. It's 75% of the ground in Illinois is rented. So, okay, so maybe there's 25% that, and a lot of that 25% that's owned is also big operations that also rent ground on top of it. I think Central Illinois, a lot of the big banks we work with was like the average client was like 20% owned land and 80% rented. So any version you look at it, I don't think a lot of those big producers are very profitable at these levels. So, that, and we talked about it too, the market doesn't necessarily care in the short run about any of that. And that would be okay if you had huge supplies coming out of South America for safrinha and they just took all the export demand and you could have, cost of production, prices below cost of production here for extended upon a time. But when those things go away, I just think that's a tough argument. Just because we rallied off the low doesn't mean that we're now at a high price. So not trying to be uber bullish here by any means, but you have to also kind of look at what the facts are and how they've changed. And we have to prove safrinha crop and Argentina crop. It's like that is our competition. And the other one's Ukraine, which is down pretty dramatically as well. So, and we have a huge book of business on and the funds are long. So the funds are right. I never like when people say, well, the funds are this, so you got to fade them. Well, that's a tough life to live.
Right.
So,
would you guys, in your opinion, I mean, do you think that the farmer has sold more grain than they generally have out forward, given some of the financial troubles that they've been facing this last 18 months? I mean,
I think absolutely. Well, I mean, I think just commitment of traders alone. I mean, there was a huge flip in ownership from commercial long to a major commercial short, and a big fund long or fund short to a big fund long. So I'd say absolutely, and we had good basis levels and, it was pretty, we were in pretty deep despair, last year at the lows, right? So we're sitting here nearly $5 cash corn, and by all means, a lot of big yields last year, right? So you were able to turn a lot of these big producers into, having a profitable 2024 or 2023, old crop, in 2024 where they had big crops. So absolutely, I think they did, and rightfully so. Now what? So.
Yeah. Well, that was the point, because we always talk about, obviously, being prudent hedgers and risk mitigating and marketing and stuff like that. But I think, a lot of guys will forward sell, get comfortable thinking that, okay, well, I've got some sort of a protectionary level, but they don't recognize that there's still an inordinate amount of risk if the story changes, right? You're the guy that maybe sold some underwater or whatever, just because if it went another 40 cents, that's still big money, but you took yourself out of the ability to try to be profitable for this upcoming season.
I think I would just add to that, like, our hedging philosophy is like, we're trying to take known risks and try to satisfy them. right? When you have crop in the bin and you have no more insurance on them, that's a different story than when you're just getting into the insurance discovery window next week and you have an unknown outcome. You have some, kind of very major popular weather forecasters. I don't really put a lot of stock in long-term forecasts, but still talking about, potential for dryness this summer. I wouldn't necessarily give that a lot of weight, but just it's a reminder that we get into the conditions that we did, in let's say 2000, end of 2008, super bearish, 2009, and we get into 2010, everyone's ready to hedge by then, right? You go to 2010, 11, 12, everyone's ready to wait for the bull market just to take them higher in 13, 14, 15. So the pendulum is very good at kind of catching people and convincing them to change their strategy right as it's about to shift. Now, I'm not saying that that's a definite, it's going to happen this year, but we see a lot of signs that the potential is still there for that shift to happen again. And I can tell you that there's a lot of appeal to try to get certainty right now and go sell corn on corn acres, even when they're 30, 40 cents below break evens, because we can't get caught in the same thing we did the last 2 years of not being sold enough. And it could be, that's the right decision, or it could be that's the wrong decision. We generally look at it though, when you're talking about an unknown yield and you're starting to get, your ability to buy decent crop insurance levels and protect yourself with other type of, fallback plans, plan Bs. I think there's just a different way of approach than just to say, I'm just going to go sell my bushels, at a 30-cent loss and see how it goes.
Yeah, 100%. I was going to add to that. I mean, that's exactly right. It's the time of year and the tool that you use to mitigate that risk, and it's the risk versus reward. So when you have highly subsidized crop insurance types, and you have farm bill that has gone up closer to the money from where we are, and these kind of safety nets, sometimes the dumbest thing you can do is double spend money at areas that you're already protected, and then take yourself out of the potential profit in the future. So 100% right. It's about managing risk, but using the right tool and the right timing. To Dustin's point, the biggest risk has been old crop corn since October by far, right? So that's kind of what you should focus on, or, use your resources there. And then when that shifts, then you do different tools or something for the next crop. But,
Ben, what's on your mind?
A couple things. Before I move on to what's initially on my mind, I think Justin makes a great point about the timing aspect of it and the decision process. Had a great meeting with Dustin yesterday and a client reviewing insurance selections. And, he brought up that a couple of years ago, because of some late price movements, it really kind of changed how you're looking at crop insurance. So I think that keeping in mind that those decisions on the calendar can change in the last, in your last 2 weeks or 3 weeks, and fully locking into something now that looks good might not be the same thing before we've got to make those final decisions. That's kind of, I think, when you think about the calendar and making decisions. And the other thing was just kind of market related, that yesterday was the first kind of macro challenge that we've seen in these markets here since the report. And I think that by and large, everything held up pretty well. And looking at inspections from yesterday, beans were not great, but we did see wheat pick up significantly and still pretty solid for corn. So yesterday's was a good kind of check. We had crude down $2 at one point. We had the S&P getting pummeled. Some other commodities were selling off pretty hard, gold in particular. And grains were pretty resilient, all things considered. So
yeah, definitely a good performance there yesterday. We've got a couple minutes here before we come into the open. Big volatility, Ryland, in cattle yesterday, $3 to $5 ranges, and all things considered, a pretty solid performance on the hog side. So what are your thoughts this morning?
Yeah, the report just, I think, solidified a little bit of profit taking, but nonetheless, it still was kind of widely regarded as supportive just because those lower placement numbers. So we did see a new high, but yeah, the trade was whipping around. So I think you got, some of the shorts here on the ropes that are looking to get out, kind of alleviate some margin exposure here. On the other hand, some of the longs are making a ton of money here, just for showing up just in the past couple weeks. So I think we're seeing a little bit of that right now. I haven't really seen too much on the cash side of the market. So I think the expectations are still relatively optimistic, but I think on, sometimes we see this kind of snowball effect. We see a little bit of profit taking, haven't seen much out of cash. I mean, you could see a pretty wide volatile range of trade, I think, the rest of the week, especially going into the inventory report. So we'll see how that kind of shapes up. But the beef market was back higher. Expectation that the kill is going to be a little light this week at about 595, probably sub 600,000 head. So we'll see how that shapes up. I mean, the trend is still really positive. It just feels like we're getting to these levels where we could see a little bit of consolidation on that side of things. And on the hog side, yeah, it's been a nice little move here. I think the cold storage report was seen as a little bit friendly. Stocks were a little bit tighter than expected. So we expect this to kind of continue. I mean, seasonally, it feels like there's a lot more optimism. There's some good margins out in the back from a producer standpoint as we get into, further out. So I think we're kind of coming to that point where maybe we're going to entice a little bit of producer hedging back there.
Very good. Appreciate the update. Just came into the open here. We got March corn up 4.5 now, 486.5. March soybeans are up 4 1/4 at 1049 1/4. And March Chicago wheat's up 5.5 at 540 3/4. One thing to note in the outro, you'll hear Jack reference a special deal running through April 1st. Give us a call. We've talked a lot about the importance of crop insurance analysis this year. Give us a call. We can bounce some ideas. Certainly would love to work with you. If you've got some questions or thoughts, always reach out and we'll be able to take care of you. Appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and subscribe. It'll keep you up to speed on everything AgYield. And again, thanks to everybody that supports the show. We're doing this live every day that the markets are open on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we look forward to talking to you again tomorrow.
At AgYield, we know that farmers are constantly confronted by new challenges, and 2025 is no exception. Markets are volatile, margins are shrinking, and lender confidence is in free fall. Farmers need industry support now more than ever, which is why we are offering something truly unprecedented. From now until April 1st, new AgYield clients can access our full suite of consulting services and cutting-edge technology at 50% off. This is more than a promotion. It's our way of extending a hand of support to farmers when they need it most. From precision grain marketing to innovative risk management strategies, we're committed to protecting your farm's profitability and building a stronger, more sustainable future. And together, we can weather the storm ahead. Visit us today at agyield.com or call 855-266-6241 to get started. Terms and conditions apply. Check out the video description to learn more.